What's good, wealth builders? It's the man, the myth, the wealth builder himself, Devon putting work and talking about what are the different types of stock. Let's go. Okay, real quick, make sure you subscribe to the channel and like the video. It helps out so much. It helped me expand the video because, if you like the video, YouTube tends to show the video a lot more. You know what I'm saying? So hook it up, man. Hook me up with a like. I appreciate it so much, right? But before we even break down the different types of stocks, let's discuss what is a stock in the first place. Stocks, by definition, are securities that represent an ownership share in a company. For companies, issuing stock is a way to raise money to grow and invest in their business. For investors, stocks are a way to grow their money and outpace inflation over time. So it's better than putting your money in a savings account or putting your money under the mattress. You know what I'm saying? So now that we understand what stocks are, we can get into the different types of stock and what they are about. Okay, I'm gonna break it down. All right, so let's get into the most preferred stock, and they name it that for a reason. Okay, it's called preferred stock. It's one of the main types of stock when a company just starts out. Okay, it's frequently compared to bonds, and it typically pays investors a fixed dividend. If you don't know what dividends are, we're going to get into that. All right. But preferred shareholders also get preferential treatment. So basically, they get the red carpet treatment. All right. So dividends are paid to preferred shareholders or shareholders, including in the case of bankruptcy or liquidation. So what that means, if a company ends up going bankrupt or liquidating, they're going to pay the people with preferred stocks first, and then all you common folk later. You know what I'm saying? But preferred stock prices are less volatile than common stock prices, which means shares are less prone to losing value, but they're also less prone to gaining value too. And preferred stock is best for investors who prioritize income over long-term growth. Okay. So basically what that means, if you get preferred stock and you get a dividend, the dividend is going to be a set amount. It's not going to go up. Now you're going to get this payment on a set date every time. Okay, that's what a dividend is. You're going to get paid this payment on a set date every time after time. A certain amount is not going to fluctuate. It's going to be this amount. Okay, that's pretty much what it is. Now, let's move on to growth stock. In finance, a growth stock is a stock of a company that generates substantial and sustainable positive cash flow, okay, and whose revenues and earnings are expected to increase at a faster rate than the average company within the same industry. It's like, let's think of a growth stock. Apple is a growth stock. Tesla is a growth stock. Google was a growth stock. FedEx was a growth stock. A lot of big companies were considered or are considered growth stock, where they expanded faster. Their stock prices exploded way faster than anybody else in their price in the type of company they are. Okay, so that's what a growth stock is. Next up, we got common stock, right? Now, like we were speaking before about preferred stock, common stock is pretty much like cousin, okay? When you own common stock, you own a share in the company's profits as well as the right to vote. Common stock owners may also earn dividends, right? On a regular basis, but those dividends are typically variable and not guaranteed. Okay, so like I was saying before, preferred stock, you're going to get guaranteed income. You're going to get a certain amount on a certain date all the time. Common stock, not so much, right? Something can happen and then it'll go up, it'll go down, it'll stay flat. It just stays at where it's at. Like this stuff, some months you might forget it. it's terrible how they treat common folk nowadays, right? But no, seriously, this is what most people buy, common stock, and yes, it does fluctuate. If you get with a company like Coca-Cola, 3M, these companies, 9 times out of 10, they have the best dividends they pay on a consistent basis. There are other companies that do also, but those are the ones off the top of my head that I think of. All right, so value stock. This is the next one. Value stock is a security trading at a lower price than what the company's performance may otherwise indicate. Investors in value stocks tend to capitalize on inefficiencies in the market, since the price of underlying equity may not match the company's performance. So basically what that means is the price of the stock could be $10, but the performance of the company could be $100 stock, right? So investors notice that and understand that. So they buy a lot of the stock go up because the market starts to realize that this company, this value stock, is underpriced, and that's why everyone is buying it. So the prices of the stock will start to skyrocket because the market starts to see it. Okay, I know. You're like, the market. Who's the market? The investors, the media. They start to notice that this particular stock starts to get purchased by a lot of investors, or one particular investor to buy a lot of that stock, and they're betting that company is going to keep progressing and keep getting better. So the stock prices tend to keep rising until they kind of match up to what the company is providing and producing at the time. All right. So a lot of speculation, a lot of research and analyzing what companies are doing and what they're not. Right. So next up, keep it moving. Blue chip. Okay. A lot of people heard of blue chip stocks. A blue chip stock is a huge company with an excellent reputation. Okay. These are typically large, well-established, and financially sound companies that have operated for many years and that dependable earnings, often paying dividends to investors. Like I said before, like Coca-Cola, Pepsi, Walmart, FedEx, UPS, General Motors. General Motors still is a blue chip stock. No, who fell off being a blue chip stock? General Electric. General Electric, GE, was a blue chip stock at one point, and then their stock did a plummet. A whole bunch of things happened to GE, and they're no longer a blue chip stock. You know why? Because the stock price crashed. Okay, so a blue chip stock has to stay up at a certain level, usually at like $100 to $200 per stock. Okay, to be considered a blue chip, and they also have to be consistent with providing dividends on a monthly basis, like I said. So blue chip stocks are those big, giant companies out there. Now, let's move on. Let's go to the other end of the spectrum. Penny stocks. Penny stocks are usually associated with small companies and trade infrequently, meaning they have a lack of liquidity or ready buyers in the marketplace. As a result, investors may find it difficult to sell stocks since there may not be any buyers at that time. Because of the low liquidity, investors might have difficulty finding a price that accurately reflects the market. Okay, so to cut through all that, basically what a penny stock is like $5 and below stocks. So the price of the stock is about $5 and lower. Okay, and a lot of investors, when they see a stock that has potential, they pump it. They do a pump and dump. They buy a lot of it. So you got $5 per stock. They put $20,000 in that one penny stock, right? And buy all those stocks for $5, and they skyrocket the price. So they see the price rising, and then they go and sell, right? That's a pump and dump stock. Usually are penny stocks, okay? So if you ever see a pump and dump stock or see the term pump and dump stock, that's what a penny stock is usually considered a pump and dump stock. Most companies that come out in IPOs or come out with a lot of news behind them don't start off being penny stocks. Most companies that kind of are low key and go into the stock market and there's no real big fuss about that company, usually they're going to end up being penny stocks. Okay, that's pretty much how it happens. Right, next up we got dividend stocks. Now, dividend stocks are companies that pay out regular dividends. Dividend stocks are usually well-established companies, like I said, with a track record of distributing earnings back to shareholders, aka dividends. Okay, so a dividend is a percentage that a company pays to the common stockholders and preferred stockholders on a usually every 3 months basis. Okay, so for every quarter of the year, they pay out a dividend. Some companies pay out monthly. Some pay out on the quarter of the year, so the first quarter, the second quarter, the third quarter, like that. Or some pay the month before the quarter ends. And so companies vary when they pay. So definitely do your research if you're looking to buy dividend stocks for income. Okay, you want to know when you're getting paid, kind of about how much you're getting paid, all that good stuff. That's so you can stay on top of your income, right? So we got another one up. It's called defensive stocks. Now, this is a not well-known term when it comes to stocks, okay, the type of stocks, but it's definitely a type of stocks. A defensive stock is a stock that provides consistent dividends and stable earnings regardless of the state of the overall stock market, okay? Now, these got to be super established companies, okay? These got to be companies that have been around for a very long time, okay? Such as Procter and Gamble, P&G, you know what I'm saying? The ones that make a lot of that the baby stuff. Like I just basically had a daughter. My daughter's 2 years old, and we buy a lot of Procter and Gamble stuff, a lot of Johnson & Johnson stuff, which is another well-established company that's more like a defensive stock. Philip Morris International. I don't remember exactly what they make. I know I think they make a lot of tools and stuff like that. So they've been around a lot. And Coca-Cola, they've been around forever. They make damn near everything we drink. You know what I'm saying? Every juice that we drink, along with Pepsi. Like, they pretty much have everything under their umbrella. Like, you can't even really escape these type of companies. When you can't really escape these type of companies, you think you're buying a product that's a totally different product from a company, and you find out, you do your research, and it's theirs. It's just mind blowing how much power these companies have over the products we purchase, like Nestle. These are the defensive stocks, okay? They're not going nowhere anytime soon. All right, so next up, we have cyclical stocks. Now, funny story, my wife kind of stopped me in the middle of me making this portion of the video, because I was saying it in a totally different way. All right, so, but it's cyclical stocks, right? So a cyclical stock is a stock that's priced. I'm mumbling because I'm so destroyed with cyclical, right? So that the price is affected by macroeconomic and systematic changes in the overall economy. So cyclical stocks are known for following the cycles of an economy through expansion, peak, recession, and recovery. Okay, most cyclical stocks involve companies that sell consumer discretionary items that consumers buy more during a booming economy, but spend less on during the recession. Okay, I know I totally destroyed that paragraph, right? But the link is in the description. You check out the blog and you can read it for yourself. But basically, what it means is the company's stocks ride the economy. So basically, if we're in a recession, that company's stock crashes with the recession. Okay, if we are in a peak economy, we are booming, everything is rolling, that company's spiking with the peak, right? They're going up, right? And recovery, meaning 9 times out of 10, that stock is laying flat, not doing too much, not moving, it's kind of just staying low, or it's kind of staying in the middle ground, right? It's not doing much, it's not active. Those companies fall under that umbrella, okay? So if you want to read up on that a little bit more, which honestly, if I was you, I would check out the blog. That's so you can get a better understanding of the things I was talking about, because me talking to you about it and you reading it, sometimes the translation kind of, disappears. So with that being said, check out the blog. The link is in the description. All right. So, man, thanks for watching. Thanks for subscribing. It's so helpful if you like the video. That's so the YouTube algorithm can hook me up, put me out there, and get the Wealthbuilder movement rolling. All right, so it's your boy Devon, the man, the myth, the wealth builder himself, signing off for what are the different types of stock. Do remember, wealth builders, make more, save more, build more. Peace.
It's the Wealthbuilderz, baby.